Did you know the Singapore stock market just hit a record high at 4,207 points today, after waiting nearly 18 years? Yeah, pretty wild, right? Our so-called super terrible index just made a super comeback. But here's the real question. Is it finally time to invest more in the STI? Or is this just another false dawn? Stay with me till the end of this video, because I'll break down exactly what the government is doing with billions to boost our stock market, why STI is flying high right now, and what long-term income investors, like you and me, should do next. Give this video a like so more Singaporeans can understand what's going on. And don't forget to subscribe to Wealth for You, your trusted channel for dividend investing and growing your cash flow. Just a quick heads up. This video is for education and information only, not financial advice. Please do your own due diligence or speak to a licensed advisor before making any investment decisions. Chapter 1. What the government is doing to boost SGX. First up, the Singapore government is going big. They've launched a $5 billion Equity Market Development Program, or EQMDP, designed to breathe life back into SGX. Here's the kicker. There's a 20% tax rebate for companies doing a primary listing here and a 10% rebate for secondary listings. But they didn't stop there. As of 21st July 2025, MAS has allocated $1.1 billion to three major asset managers, Avanda, JP Morgan, and Fullerton Fund Management, to actively invest in Singapore-listed stocks. This is like fuel injection for our local market. Their goal? Boost daily trading liquidity, shine a spotlight on undervalued small and mid-cap stocks, and yes, bring back investor excitement to the SGX. Chapter 2. What's in the STI Index? So what exactly is in the Straits Times Index, or STI? Well, the STI is made up of 30 of Singapore's biggest listed companies, but here's the thing, not all of them matter equally. Like a school group project, some members carry way more weight than others. Right now, 4 companies are doing most of the heavy lifting: Singtel, DBS Bank, OCBC, and UOB. These 4 giants are the powerhouses behind the STI's recent surge. Their performance alone has driven the index to new heights, and we'll explain more in a bit on how they pulled it off. Chapter 3. STI's past versus overseas indexes, a rocky climb. Let's be honest, the STI hasn't had the smoothest ride. Back in 2007, the Straits Times Index peaked around 3,800 points. But then came the global financial crisis, and bam, it crashed by over 1,600 points. And here's the painful bit. It took 18 long years for the STI to crawl back above that peak. Yes, 18 years. That's like graduating secondary school, going to uni, building a career, and only just seeing your investment break even. But before we feel too sorry for ourselves, let's zoom out and see how other markets did. The Nikkei 225 in Japan peaked in 1989 and only returned to that level 30 years later. That's 3 decades of disappointment. The FTSE 100 in the UK took a hit too, but managed to recover in under 10 years. That's impressive resilience. Malaysia's KLCI moved up and down a bit like the STI. Overall, same pace, same struggles. China's Shanghai and Hang Seng indexes are still stuck below their old highs, volatile, unpredictable, and no clear recovery in sight. Meanwhile, the S&P 500 and Nasdaq in the US didn't just recover, they skyrocketed. If you had invested in either after the 2008 crash, you'd be multiplying your money many times over by now. So where does that leave Singapore? The STI may be stable and dividend-friendly, but compared to the growth stories overseas, it's been more of a slow and steady turtle than a sprinting hare. The silver lining? Singapore's stability and strong dividend culture still make it a solid long-term income play, especially for those who play the compounding game right. Chapter 4. STI hits all-time high. What's going on? Alright, now let's talk about the big headline. As of today, 21st July 2025, the Straits Times Index closed at 4,207 points. And guess what? Earlier in the day, it touched an all-time high of 4,225 points. Yes, you heard it right. Record high, baby. Cue the champagne. Or, at least a ping. But wait, what's powering this rally? Why is the once super slow STI suddenly acting like it's on Red Bull? Let's break it down. First, global interest rates are falling. Around the world, interest rates are sliding down again. What does that mean for investors? Cash and fixed deposits no longer look sexy. So where does the money go? Back into stocks. Global funds are flowing into equities, and yes, some of it is finally flowing into our local SGX stocks. Second, Singapore's $5 billion market booster. The Monetary Authority of Singapore isn't just watching from the sidelines. They're actively pushing with a $5 billion equity market development program. And out of that, they've already deployed $1.1 billion to asset managers like Avanda, JP Morgan, and Fullerton to pump directly into Singapore-listed stocks. Think of it like SGX getting a double espresso shot. Liquidity is flowing, confidence is rising, and investors are starting to take local stocks seriously again. Third, STI's Big Four are on fire. The STI is made up of 30 companies, but let's be real. It's really Singtel and the three banks, DBS, OCBC, and UOB, that are doing the heavy lifting. Singtel's new CEO has been aggressively monetizing assets and unlocking value. The banks, thanks to elevated interest margins and share buyback programs, have all seen their share prices push higher. They're leaner, stronger, and raking in profits. Together, these four stocks are pulling the whole index up, like Ah Beng pulling his gym khakis up Bukit Timah Hill. So yes, Singapore's STI has awakened from its 18-year slumber and is finally flexing some muscles. But where do we go from here? That's what we'll explore in the next chapter. The future of STI and what income investors should do next. Chapter 5. What's next for the STI Index? And what should income investors do? The big question now, where does the STI go from here? After finally smashing through the 4,200 barrier, some investors are asking, should I chase this rally? Others are worried about a pullback. Let's break it down. STI could still push higher, but only if conditions stay favorable. Yes, there's momentum, but for the STI to keep climbing, we still need: first, falling global interest rates. This drives more money into stocks. Second, MAS's recent $1.1 billion liquidity boost plus $5 billion commitment. A strong show of support. Third, strong earnings from top counters like Singtel, DBS, OCBC, and UOB. That's real fuel for growth. But let's keep it real. Don't ignore the risks. The STI is still heavily weighted in banks, and they're interest rate sensitive. If rates are cut too quickly, bank net interest margins could shrink, putting pressure on profits. That said, our big three banks aren't sitting still. DBS, OCBC, and UOB are pivoting into wealth management, insurance, and buybacks. Smart diversification to defend earnings. Still, don't expect a smooth ride to 4,500 or 5,000. Volatility is part of the game. So what should long-term income investors in Singapore do? Here's how to stay one step ahead, without chasing hype. 1. Stick with your DCA plan. If you've been dollar-cost averaging into the STI ETF, REIT ETFs, or dividend stocks, keep going. Don't change strategy just because prices are up. Consistency beats timing, especially in income investing. 2. Diversification is your best defense. Balance your portfolio by adding REITs, industrials, and monthly income bond funds alongside your core holdings. That way, you're not just relying on one income source. You're building a more stable and resilient dividend stream through all market cycles. 3. Buy the dips with your war chest. The market will dip, that's guaranteed. But you're not panicking. You're ready with a war chest, scooping up quality dividend stocks at better yields. 4. Don't chase the rally. Sure, STI's pumped, but don't go all in on what just did well. Instead, be selective. Look for undervalued REITs and industrials with solid fundamentals. Revisit gems like ST Engineering and Singtel, which are transforming. That way, you're not just riding one wave, you're building a resilient income stream across market cycles. Final thoughts. Stay on course, but don't put all your eggs in one basket. The STI Index is no longer the super terrible index. With government support, renewed investor confidence, and strong performance from banks and key players like Singtel, the market is showing steady strength. But here's the smarter move. Stick with the income heroes: DBS, OCBC, UOB, Singtel, and high-quality REITs. Pair them with REIT ETFs to smooth out volatility and get broader exposure across sectors. Diversification is key, not just across asset classes, but also within them. Own banks, but don't go all in on them. Hold Singtel, but mix in other dividend payers. Invest in REITs, but balance across different subsectors: retail, industrial, and overseas. Use REIT ETFs to capture steady income with less guesswork. And add monthly income bond funds for lower risk, regular payouts. This mix gives you stability, growth potential, and multiple income engines, so you're not overly dependent on any one stock or sector. Summarizing for the income investor: keep reinvesting your dividends. Stay the course with banks, Singtel, REITs, and REIT ETFs. Add monthly income bond funds for smoother cash flow, diversify smartly, and don't overconcentrate. Stay patient, and let compounding do the heavy lifting, and always keep that war chest ready. If you found this video helpful, do your part to support financial literacy in Singapore. Tap that like button. It helps more Singaporeans discover this content. Subscribe to Wealth for You, where we keep investing real and relatable. And don't forget to hit the notification bell so you never miss an update. Drop a comment and let us know if you're holding STI stocks, REITs, or REIT ETFs. And also, what income asset are you planning to add next? We'd love to hear your strategy. Thanks for watching. And remember, wealth isn't built by chasing, it's built by compounding. And in the end, cash flow is king. See you in the next one.